So simple tutorial.
Money plays a very important role in our life. For every kind of transaction that we make, we use money. We use it to buy food, clothes, pay rent, and purchase our Netflix subscription. We also use it to pay tax to the government. We also use it as a gift for a cousin or friend when we are confused about what to get them on their birthdays. Even for paying the services of a barber or a doctor, we need money. That means services are also exchanged with money. Good morning, students. I am Vijay Singh, your social science teacher for grade 10, and you are watching So Simple tutorial. Today, we are doing one short revision of the lesson Money and Credit. So, for every transaction, whether we buy a good or service, we need money. Now, the question arises, why do we make transactions in money? The answer is simple, because the person holding money can easily exchange it for any commodity or service that he wants. Then how exchange took place in the society when money was not used? In prehistoric times, commodities used to be exchanged for commodities directly. This was known as barter system. But this system proved difficult and inconvenient for the people. The main difficulty was the lack of double coincidence of wants. Just think how difficult would it be to have a coincidence that the two parties agree to sell and buy each other's commodities. But in the modern economy where money is in use, money eliminates the need for double coincidence of wants. The basic function of money is to enable buying to be separated from selling, thus permitting trade to take place without the so-called double coincidence of barter. Okay. Now you sell your goods to a person who needs them, and from the money thus obtained you buy the good or service that you need. So in the modern system, money acts as an intermediate in the exchange process. Hence money is called a medium of exchange. Let us now switch over to the next easy topic, modern forms of money. Modern forms of money include currency, that is paper notes and coins. Currency is a medium of exchange for goods and services. In short, it is money in the form of paper notes and coins. Before the introduction of coins, a variety of objects was used as money. For example, in ancient times, Indians used grains and cattle as money. These commodities were widely accepted as a medium of exchange. Then came the use of metallic coins, coins made of metals like gold coins, silver coins, copper coins, etc. Gold and silver coins are not used today, but still they are valued a lot. People buy gold and silver coins from their savings and keep at home even when not in use. Why? Because they have the value of their own. They have their own intrinsic value. What is astonishing here is that modern currency is made neither of gold nor of silver nor any other precious metal. Then why it is accepted as a medium of exchange? It is accepted because the currency is authorized by the government of the country. It has a legal sanction behind it. It is a legal tender. No one can refuse to accept it as a means of payment. The other forms in which people hold money is as deposits with banks. Generally, people keep some money at home to meet their day-to-day needs. They keep the rest with the banks by opening an account in their name. There are many advantages of depositing money in the banks. What are they? First, the money is safe there. Second, you can earn interest on the deposited money. Third, you have the provision to withdraw the money from there whenever you need. Fourthly, you can make payment through check. The facility of check against the demand deposits makes it possible to settle payment without the use of cash. Time is moving fast forward. Today is the age of plastic money. Debit cards and credit cards are examples of plastic money. People prefer to use plastic money as a form of payment. It is quite safe and a fantastic method to avoid carrying cash around. Let us now revise the next topic, loan activity of banks. When people deposit their money with the banks, what does the bank do with that money? The deposits received by the commercial banks are not allowed to sit idle in the cash box of banks. As we revised just now, banks allow the depositors to withdraw their money when they need them. To attend to such depositors who might come to withdraw money from the bank on any given day, banks keep a small proportion of the deposits as cash with themselves. These days, banks normally keep 15% of their deposits as cash. After keeping such cash reserves, the rest is given by the banks to the needy borrowers in the form of loans. Banks charge a higher rate of interest on the loans given than what is paid to the depositors. The difference between what is charged from the borrowers and what is paid to the depositors is the main source of income of the banks. So the depositors earn interest whereas the borrowers pay the interest. And this is how the banks mediate between those who have surplus funds and those who need these funds. Now let us see another subtopic, two different credit situations. We will go through two stories to understand the different credit situations. First, the story of Salim and then the story of Swapna. Salim is a shoe manufacturer. It is the festival season 2 months from now. Salim gets an order to make 3000 pairs of shoes by a trader. He gets 1 month to deliver the shoes. Time is less. So to complete his work on time, he must hire a few workers for stitching and pasting work. He has to buy raw materials also. Now he needs money to meet his expenses. So he goes to the leather supplier first. He asks the leather supplier to supply leather now and promises to pay him later. Then he goes to the trader who gave him the order. He asks him to pay for 1000 pair of shoes as advance payment, which he gets easily. So now he has both the raw material and the working capital with him. He starts working and is able to deliver the order by the end of the month. Salim earns a good profit. He pays the money to the leather supplier. So what is the role of credit here? Here, credit has helped him to meet the ongoing expenses of production, complete production on time, and thus increased his earnings. Let us see the second case. Swapna is a small farmer. She has 3 acres of land. She grows groundnut there. Normally, she takes loan from the moneylender to meet the expenses of cultivation. But unfortunately, this time her crop is hit by the pests. Though she sprays costly pesticides on her crops, yet she could not save them. Crops fail. The result is that she is unable to repay the moneylender and the debt grows over the years into a large amount. Then comes the next year. She takes a fresh loan for cultivation. This time the crop is normal, but the earning is not good enough to cover the old loan. She is caught in a debt. So she has to sell a part of her land to repay the loan. So what is the role of credit here? Instead of helping Sapna to improve her conditions, it made the conditions worse for her. This condition is called debt trap. Debt trap is a circumstance in which it is difficult or impossible for a borrower to pay back money that they have borrowed. So, in the first case, credit helped Salim to increase his earnings and therefore he is better off than before. Hence, credit played a positive role. In the second case, because of crop failure, credit pushed Sapna into a debt trap. Hence, credit plays a negative role here. So whether credit is going to be useful or not depends on the risk in the situation. Let us now revise the terms of credit. Terms of credit refers to the conditions that are attached to a loan. These may relate to rate of interest, collateral, documentation required, and mode of repayment. All these things are discussed and finalized before the loan is given. At what interest the borrower is accepting the loan is clearly specified in every loan agreement. Accordingly, the borrower pays the interests besides the principal amount. Then comes the collateral. Collateral is an asset that the borrower uses as a guarantee to a lender until the loan is paid. If the borrower fails to repay the loan, the lender has the right to sell the asset or collateral to obtain payment. Properties such as land titles, deposits with banks, livestock are common examples of collateral used for borrowing. Then the lender may ask for certain documents to ascertain few things. Lenders may like to know how sound is the financial condition of the borrower to assess the repaying capacity of the borrower. To verify these things, the banks may ask for the bank statement for the last 6 months or so. To the self-employed, they may ask for the income tax returns filed by them. Okay. The mode of repayment is also important. This means how the borrower has accepted to pay back monthly, quarterly, half yearly or yearly. These things are very clearly shown by an example of a house loan through the story of Megha. You can go through it once again yourself. Remember, the terms of credit vary from one credit arrangement to another. This also depends upon the nature of the lender and the borrower. Let us now go to the next topic, formal sources of credit. So far, we have seen various sources of credits, namely banks, money lenders, landowners, cooperative societies, etc. We can now group them as formal sector loans and informal sector loans. Loans from banks and cooperatives come under formal sector loans, whereas the loans from money lenders, relatives, friends, etc. come under informal sector loans. Formal sources of credit are supervised by some formal government organizations, whereas there is no organization to supervise informal sources of credit. They can lend at whatever interest rate they choose. In India, the RBI supervises the functioning of formal sources of credit. Formal sources follow rules and regulations formed by the government, whereas the informal sources do not follow any rules and regulations. And another most important difference is that formal sources of credit charge a very low rate of interest, whereas the informal sources charge a very high rate of interest. The terms of credit are fair and reasonable in formal sources of credit. The informal sources impose very tough and even unreasonable terms. You can see graph 1 given in your book. It shows sources of credit for rural households in India in 2019. You can find here commercial banks, cooperative societies, landlord, money lenders, traders, relatives, friends, etc. It also shows how much of the loan they are giving. So you can find out how much credit is coming from the formal sources and how much is coming from the informal sources. Let us now discuss something about Reserve Bank of India. As I said, in India, the RBI supervises the functioning of the formal sources of loans. So in what ways does RBI supervise the functioning of the formal sources of credit? First, we have already read that banks maintain a minimum cash balance out of the deposits they receive. The RBI monitors that the banks actually maintain the cash balance. Second, the RBI monitors that banks give loans not just to profit-making businesses and traders, but also to small cultivators, small-scale industries, to small borrowers, etc. Third, banks have to submit information to the RBI periodically on how much they are lending, to whom they are lending, and at what rate of interest they are lending, etc. Fourthly, the rate of interest of the formal lenders is decided by the RBI. So normally the interest rates are very low compared to the informal lenders. Most of the informal lenders charge a very high rate of interest for loans. This is how RBI supervises the functioning of formal sources of credit. Let us now revise a very important question from the board examination point of view. Cheap and affordable credit is crucial for the country's development. First, higher cost of borrowing means a larger part of the earnings of the borrowers is used to repay the loan. Hence, borrowers have very less income left for themselves. Second, in certain cases, the higher rate of borrowings can mean that the amount to be repaid is greater than the income of the borrowers. This could lead to the increasing debt, and finally, borrower will be caught in a debt trap. Thirdly, people who might wish to start an enterprise by borrowing may not do so because of the high cost of borrowing. They just abandon the idea because the rate of interest is too high. It is for these reasons we say that the banks and cooperatives need to lend more. This would lead to higher incomes, and many people could then borrow cheaply for a variety of needs. People could grow crops, they could do business, they could set up small scale industries, etc. They could set up new industries or trade in goods. Thus, cheap and affordable credit is crucial for the country's development. Look at graph 2 now. It is related to sources of credit in urban areas. This graph shows that 54% of loans taken by poor households in the urban areas are from informal source, whereas the loans taken by rich households are 83% from the formal source and only 17% from informal sources. This pattern is similar to those in the rural areas. The rich households are availing cheap credits, whereas the poor households have to pay a heavy price for taking loans. So what is the solution? The solution is that banks and cooperatives should increase their lending, particularly in rural areas, so that the dependence on informal sources reduces. Secondly, while formal sector loans need to expand, it is also necessary that everyone receives the loan. At present, it is the richer households who receive formal credit, whereas the poor have to depend on informal sources. So the next question, why are poor still dependent on informal sources of credit? Firstly, banks are not present everywhere in rural India. There is a serious shortage of the banking system in rural areas. Second, even if they were present, getting a loan from a bank is much more difficult than taking a loan from informal sources. The problem with the formal system is that some kind of collateral is required. The rural poor in need of urgent credit do not generally possess any collateral. Consequently, they are ruled out of the formal banking system. On the other hand, informal sources such as money lenders know the borrowers personally and hence give the loan without collateral. We know that the money lenders charge a very high rate of interest and even sometimes harass the poor borrowers. Yet they approach them. Why? Because sometimes, if necessary, the borrower gets a loan from the money lender even without repaying their earlier loans. To help such people, to help such kind of people, self-help groups emerge on the scene. Self-help groups are successfully bridging the gap between the formal credit system and rural poor. A self-help group is an association of poor people, especially women, who belong to the same social and economic background. They pool their savings and manage their credit needs. The objective of the self-help group is to organize rural poor, especially women, and to inculcate saving and banking habits among members. How it works? A typical self-help group has 15 to 20 members, usually belonging to the same neighborhood. Members of the group meet regularly and make their share of contributions. Share per member varies from Rs 25 to 100 or more, depending on the ability of the people to save. Members can take small loans from the group itself to meet their needs. The group charges interest on these loans, but this is very less than what the money lender charges. The loan borrowed from the self-help groups are collateral free, and the peer pressure of the group ensures that timely repayment of loan happens. One important feature of this group is that most of the important decisions regarding the saving and the loan activities are taken up by the group members themselves. The group decides the amount of the loan to be granted, interest to be charged, and the repayment schedule, etc. After a year or two, if the group is regular in saving, it becomes eligible for availing loan from the bank. A self-help group must maintain ledger or register regarding the attendance of the members, its savings, credits disbursed, repayments, and minutes of the meetings. This helps them in easy opening of the saving bank account in the name of self-help group in the banks. Loan is sanctioned in the name of the group and is meant to create self-employment opportunities for the members. For instance, small loans are provided to the members for meeting working capital needs like buying seeds, raw materials like bamboo and cloth, for acquiring assets like sewing machine, handlooms, cattle, etc. Thus, the self-help groups helps borrower overcome the problem of lack of collateral. They can get timely loans for a variety of purposes and at a reasonable rate of interest. These self-help groups are the building blocks of organization of the rural poor. Not only does it help women to become self-reliant, the regular meetings of the group provides a platform to discuss and act on a variety of social issues such as health, nutrition, domestic violence, etc. This, my dear student, brings us to the end of revision. I hope you must have benefited from this. In the next class, we will meet with the revision of some other lesson. In this channel, besides lessons and one-shot revision, you also get MCQs. Very shortly, you will get competency-based questions. So subscribe to this channel and stay connected. Jai Hind.